Hello and welcome to today's webinar, to the monthly webinar put on by FX Street. My name is Brian Kahn, and this is titled Developing Your Trading Personality. So yes, a little bit of technical difficulty, so we are starting a little bit late, but my name is Brian Kahn. I'm coming here Jupiter Peak Financial, a trading and consulting firm. So hello to all of you. I like to say in my webinars, good morning, good afternoon, and good evening, depending on where you're joining me from around the world. So thank you very, very much. There you have my email if you have any questions, and then you also have an address, a blog address there below. And actually, I'm going to show you this on FX Street as well, because everything that I post gets reposted right to FX Street's page. So that's where, if you're looking for my information, in fact, we'll just go there now because we're going to be popping back and forth on some applications. So I'm just going to bring up that page right now so you can find my collaboration page, if you will. Okay, and so I'm just pausing as I move from application to application, but you can see the FX Street.com page is up here, and if you just search for my name in there, you'll find my main page, and I write daily market commentary almost every day. So I did put a post up yesterday, kind of in preparation for where we're going today, and that was called Trading Opportunities Using Intermarket Relationships. So you can see that right here. So that is my author page, if you will, on fxstreet.com. So moving back into the slides here, just very quickly, I want to make sure that you do see this disclaimer. This is pretty important, and I'm just going to leave this up for a few seconds so that you can read it. And this is also important because I'm going to be going into a brokerage, and I'm also going to be showing you some different sites and things like that. So none of those pages, none of those brokers are recommendations. It's very, very important that you go ahead and do your due diligence depending on your own personal situation. So no, you have to make sure that you're understanding what you're going for as far as different time frames for trading and different frequency, all of the stuff that we're going to talk about your trading personality. So I just want to make sure right off the bat that you understand that this is for education only. So a little bit about me. I think it's worth going in and just explaining who is talking to you today so that you have a better reference point as we start to go into some of the material. So the first line there says ski bum. I wanted to be a ski bum. That is a true story. And while I was doing a very good job of being a ski bum, I met a trader. I didn't know anything about the financial markets. And I didn't know anything about the financial markets, and so I was fortunate enough to meet this person, and I laughed at this relationship that I started with this person because he was a true trader. And so I thought, okay, I'm going to meet this person. I'm going to go work for him. I'm not going to be a ski bum anymore. I'm going to learn all about finance and investing and all that kind of stuff. And so my first question to him is, I said, I want to learn about long-term investing. And he said, don't ask me, I'm the worst long-term investor out there. And I said, what do you mean? He said, I'm a scalper. So that's where I began my trading education, was as a scalper, trading very, very, very short-term movements in and out for seconds at a time. And this was from 1998 to about 2006. So for about 8 years. Scalping was a lot of fun. We had an office that was built for it. So that's what you have to remember, is my office was built for speed. We were some of the fastest in the world at getting various prices. So that's obviously something to think about if some of you are going to be scalpers, who you're competing with out there. Offices in Tokyo, in London, and Frankfurt and New York and Chicago that are built for speed, that are faster no matter how fast the line coming into your house is or wherever your trading office may be. That's what these people are built for. So scalping is a very, very specific technique, and it taught me how to read market flow, to see bids and offers and things like that. And I learned technical analysis, fundamental analysis. So that was my introduction to that. So moving from scalping, so when I left Chicago, where I was scalping, and that's where my office was, and I moved, I knew what I was doing. I was actually moving away from the financial markets. Technology had come a long way. And so when I moved, I realized that I wasn't going to have the same speed. So I adapted my trading style. So I wasn't competing with all of my friends back in Chicago. And I adapted to various markets, various strategies, and various time frames. So not just scalping one individual entity in one market. Now I started trading multiple markets, seeing how they all related together. And I've been trading at this time for over 8 years. And as I started to learn these other markets, I just started to laugh and say, I can't believe it took me so long to learn this. So someone is coming in with a question. How did you manage to scalp and not have one heart attack per week? Well, remember, no matter if it's scalping or if you're swing trading or intermediate trading, whatever it may be, you have trading plans. That's what we're going to talk about today. So we had very good risk management for every time that we were on. We had an office built for this type of strategy. We had controls in place. So yes, it seems stressful, but it wasn't as stressful as most people think it was because there were plans. There was a lot more thought process going into it. And that's the same for when I adapted to various markets and strategies and timeframes. I traded for 8 years in the bond futures markets. I'd never touched the Forex market. I'd never touched options. And I found these new markets to be wonderful, wonderful markets to be involved in. And so as I started to adapt, and it put me in a better place to understand more than just my little niche of scalping, people started asking me for help. The crash of 2007 happened in early 2008 and into mid-2008, and I said, wow, people are scared. And my thought process at the time was, this is big. This is something that's going to be with us for the rest of our lives as far as this economy being in the news and people trying to have retirement plans and all that kind of stuff, and trading might have to be some added part to these people's income because employment is never going to be the same and salary cutbacks and whatever it may be. So people are going to pay more attention to the markets. So I founded Jupiter Peak Financial as a consulting firm in 2008. And just like I approach trading, that's how I teach people. So I teach them basically what I'm looking at and what's helped me to be successful. So just to let you know what I teach, okay, what I trade. I trade foreign currencies as a scalper. So yes, I'm still a scalper. I've actually invented a term. I've combined scalping and swing trading. So I don't trade for nanoseconds at a time anymore. I trade for minutes at a time. It all depends on the volatility, and that's what we're going to talk about. All depends on the volatility. So instead of nanoseconds, now I've adapted a little bit. So it could be a 5-second trade, could be a 10-second trade, could be a minute trade. So again, it depends on the volatility. So I use foreign currencies for intraday trading. I also use foreign currencies for intermarket relationships, something we're going to talk about throughout the day today. There's a lot of relationships between equity markets and commodities, different sectors, and also the foreign currencies. So I use foreign currencies also to hedge an equity portfolio, a retirement portfolio, all right? And then I also have an equity portfolio that has options and equities and things like that, mutual funds in it. And so that's where I'm always going back and forth. Is this a short-term trade because there's volatility in Forex, or is this a longer-term trade to hedge the equity markets? And that's what I help people with. I help people who are interested in being day traders because they have the means to do that, and not everybody has the means to do that. They have the time, they have the account size to do that. And then I also help people with larger account sizes try and spread their risk out a little bit and maybe play the downside. A lot of people pay for health insurance. A lot of people pay for auto insurance. A lot of people pay for life insurance. But as a lot of people found out in 2001 and a lot of people found out in 2007 and 8, that they don't have portfolio insurance. And so right now, the markets are telling us we don't need portfolio insurance because they're doing very well, but that may change. So I teach people those strategies. Scalpers get scalped. Again, someone is saying, I heard scalpers get scalped. Maybe, no matter what time frame people are on, people can have a bad experience in the markets, no matter what entity they're using, equities, options, futures, Forex, cash, it doesn't matter. So again, it's got to go back into your own personal trading plan and what you can achieve. And that's what we're going to talk about today. It's all about you. You're the system. We're going to define you as a system first. Someone was asking, trade execution you did was fully automated. No, it was absolutely, totally manual, with stops and with targets in, using fundamental and technical analysis and updating our analysis constantly. And so that's never changed. My time frame may have changed, but the way that I get in, the way that I put stops and targets and things like that, the stuff we're going to go through today, that hasn't changed at all. So let's move on to the next slides. Before I do that bottom line though, my approach to teaching, again, everybody that I work with is different, and so I've got to look at them as a single entity and what's going on in their life and account size and goals and things like that. And then we start to look at the overall economy. We look at the big picture first. We look at economic policy and things like that are going on now. That's what we're going to talk about, because there are some big things right now behind the scenes that are really driving the financial markets. So I just wanted to explain that there, but here I just wanted to give you a chance to see it. So my Forex trading strategies, again, that's where I invented that word a little bit. I don't know if I've invented it, but I use it. I am a combination in Forex markets of scalp and swing. Mostly scalp. It's mostly a short-term trade, but yes, I do use longer-term opportunities, daily charts and longer-term charts to hedge equity markets and use those intermarket relationships. Even if it's not a hedge, I might see a relationship because I'm paying attention to the various different markets out there and what's going on fundamentally and technically. Options are an incredible market to use. They can grow an account. They can create what we call income strategies in an account. Again, income, you have to know what that means for an option strategy. So again, no buy, hold, or sell recommendations. Anything I talk about today, any strategies I talk about, make sure that they're right for your own individual situation, and hopefully you'll have a better understanding of that after today's presentation. Portfolio protection, I think that options provide that. I think Forex can provide that. So a lot of long-term investors, when they find out I'm a trader, they say, wow, you're risky. And I say, whoa, you're an investor. And I say, you're the one who's risky. Because obviously people look back and say over the past 10 years, their equity investments haven't done anything. So that's where I say, look at all this movement that's happened in the past 10 years. That's why options are great. That's why Forex markets are great. That's why the markets as a whole are great. But you have to know what's right for you. So someone asked a question, have you discovered the Holy Grail? And if so, what is it? Very, very, very good question, because you guys are the Holy Grail. That is where we're going today, talking about your trading personality. Everybody tries to find the Holy Grail. Every book that you ever see is about this strategy, this strategy, this strategy. No one's ever developed a book that says you as an individual are the Holy Grail. Find out who you are as an individual, and I think that you have a much better chance of success. So before we go into that, why do I teach? People ask me all the time, why do I teach? And so if I wasn't trading, I guess I would be a full-time professor. But first and foremost, I'm a very social person. I enjoy people. I get a lot out of it. Sitting in your room, in your office, wherever it may be, trading can be lonely. And obviously when you're lonely and things aren't, markets aren't moving or whatever it may be, you might just say, I'm a trader. I'm forced to do something. And so there's a lot of pressure to be a trader and sit in that room and do something. And that's the hardest part about it, is learning patience, learning when to trade. So I like it. It kind of actually takes me away from the computer sometimes and gets me more on a macro scale, looking at someone or working with someone, and I might actually be learning something that I might not normally look at, a stock or a sector or a relationship. So I've definitely, the better I teach my students, the more I'm learning. Credibility, I've traded for over 14 years, and I teach. I think it works both ways to give that credibility back and forth. I work for some local institutions here at university. I think it does build credibility to work with great organizations and institutions, and obviously FX Street, which is one of the top providers for news and analysis out there. So I'm very happy to be on board with FX Street. The accountability, it works both ways. So this is a major part of it, accountability. The more I'm teaching and working with other people, I'm holding them accountable in this relationship when I work with them. And so I've got to hold myself accountable as the teacher as far as what I'm doing in my own trading. So that accountability works both ways. Also, I do manage portfolios for other people. I have a Series 65 registration. I understand fiduciary responsibilities. So I work very closely with that individual person to understand everything about them and develop a strategy that fits their personality. So not only am I doing this for myself, but I do work with other people as far as managing portfolios and things like that. So that's the credibility I think that I can bring to the plate when I'm teaching. So an outline of where we're going. So just like that person just asked about the Holy Grail, you are the system, you're the Holy Grail, that's what we're going to talk about. So who are you as an individual? We will break down 4 types of traders. We will go into different types of Forex accounts because I think that can be confusing to people. We can go into account and trade risk. I think that's very important so that you're managing your portfolio correctly. And then we'll go into market volatility. A lot of Forex traders don't understand how to read volatility. I think it's very important. Option traders, volatility is very important to them. But no matter who you are as a trader and what market you're using, I think that volatility drives us. So I think this is a huge point. And then we're going to go ahead and focus on percentages and always being realistic. Not dollars, not money. Focus on percentages, what your money is doing percentage-wise, and be very realistic. So that word you is bolded. You are the system. I believe, with my years of experience trading and consulting, that if you understand who you are as a trader, you have a chance to succeed. So that's what we're going to do today is we're going to define your trading personality. Yes, you guys are the Holy Grail, each individual one out there. Who are you? So in the Forex markets, they're 24 hours a day, but that doesn't mean we should be trading 24 hours a day or we should be trading, depending on where we're at. So first and foremost, where do you live? What part of the world do you live in? And really make it easy on yourself. I believe that you can trade when it works for you. I have a very hard time believing that people can go to work all day, come home maybe to a family, and then say, okay, I'm going to sit down and I'm going to work at the markets for 5 or 6 or 7 hours and basically sleep for 2 or 3 hours a day. So I have a very hard time believing that people who work all day and have a job and have a boss looking over their shoulder, whatever it is, can go ahead and be day traders. And that's where some people get goofed up and get messed up. And they try and basically make the markets work for them. You guys, okay, are a puzzle. Each one of you is a puzzle. I actually woke up in the middle of the night thinking about this the other night. Each one of you is a puzzle, and the market is just this big, huge mess of puzzle pieces out there. Well, you've got to take your puzzle piece and fit it in somewhere in there. It'll fit, but if you're realistic about who you are, then I think you can get it to fit somewhere, and I think you can have some success. Someone said, I'm trying to get some results from Forex for the last 3 years, but now nothing. I'm a dummy head? Absolutely not. Maybe you didn't go through this process and realize what you can achieve. So I don't think there's any dummies out there. I think that you just have to take a step back and go through this process. Let me just give you a case example. I was working, someone wanted to work with me, and they told me about their situation and their account size and how much they were working at their primary job and their family situation and kids and things like that. And I said, what do you do for a living? And they told me their profession. And so we started to talk about it because they actually owned a small business. And then I said, what are your goals with Forex? And he said, I want to make 25% per month. Okay. And 25% per month is very common. A lot of people want to do that. They want to make 100% per month, whatever it may be. And so I said, as a business owner, can you make 25% per month, month over month over month? He goes, no way. I said, even if you work 24 hours a day and never slept and never visited your kids and your family, whatever it was, could you make that money? He goes, no, there's not enough business out there. I said, what gives you the right to be brand new, come into the Forex markets, compete with people like me, who basically want to rip people's heads off who come in undisciplined and say, I'm going to be brand new at this. I can't focus on it all the time, and I'm going to make 25% per month. That's an unrealistic expectation. All right. So a question, I'm just trying to bounce back and forth. Did you choose to be a scalper, or are you led into this section? I'm not sure if I understand that question, so maybe you can retype it. The bottom line is, you guys, as I put in that outline, please be realistic. Not everybody can be a scalper. Not everyone can be a day trader. You've got to figure out what's right for you. So make it easy on yourself. You can trade when it works for you. You have your schedule. You've got to work around your schedule, whatever it may be. If you're retired and you have all the time in the world, great. If you're working and that's your primary source of income, that's got to be your focus. Focus on that first. Don't give up your day job. And as people come home from work, wherever they are around the world, and then they turn on the Forex markets because they're moving, they want to trade them, how much do you know about every banking center in the world? I live in the United States. I don't try and trade in the middle of the night when Australia and New Zealand are going against each other as far as their currency, because I don't live in Australia, and I don't live in New Zealand, and I have no idea what's going on in their banking center. Yes, I can look online, and I can use FX Street for analysis and things like that, but I'm not there, okay? I'm in America. There's one currency pair right there called USD. That's one. I understand that currency. Now I have to compare it to something else. So make sure that you're understanding where you are and what's basically achievable for you as far as trading in time frames. Again, a case example, the trading of the Euro GBP during European equity session. So if you live in Europe, that might be a good one for you, or if you're, over towards the Far East, that might be a better one for you than trading a U.S. one that is closed maybe when you're up. So again, it all depends on when you're able to be in front of the markets. And a major question that I think people forget to ask, how much time in front of the markets per day? How many hours can you be in front of the markets, and is it consistent? You cannot turn on the computer for 45 minutes and say, I'm going to be a day trader and try and get a trade off, or a scalper, and then close it and then come back 4 hours, 5 hours later, turn the computer on for an hour and try and be a day trader. When I work with people, day traders must be in front of the markets for at least 5 to 6 hours consistently in a row. So there's a question, are scalpers usually impatient people? Yes, if they're trying to scalp around their schedule. If you say the markets are this, and scalpers are required to be right here, what I just talked about, 5 to 6 hours a day, there's no reason to be impatient. And we're going to talk about volatility and what's going on with the markets right now. There is no doubt about it, the markets are interesting right now. They're providing opportunity. They may not be providing the opportunity that traders of 15 years like I've been around are used to, because they actually are less volatile. And that's something that if you don't understand that and aren't aware of that, that should be new information for you today. So you don't need to be impatient if you understand what the markets are giving you and that you have all day to make a trade. And if you don't make a trade today as a day trader or a scalper, that's just fine. If you don't make a trade tomorrow, that's just fine. If you don't make a trade the next day, that's just fine. Let the markets tell you when it's time to trade. So another question, do you concentrate on only one FX pair when scalping, or you scan 3 to 4 volatile pairs for best setups? I have no problem telling you what I'm focusing on. Like I said, I'm here in the United States. I understand this economy, and I focus on 6 U.S. majors. All right, pound U.S. dollar, euro U.S. dollar, Aussie U.S. dollar, New Zealand U.S. dollar, U.S. Canadian, and U.S. Swiss franc. Just like in equity markets, I work with people that don't even know about Forex or would never touch Forex. I work with people in the equity markets. They don't get 1,000 equities that are out there, or 10,000 that are out there in the Dow Jones, and all over the place. They get 10 to 15 to 20. They get a watch list that they can afford to trade. So it's very, very finite as far as the rules that are created. So that's a very, very good question. The watch list, develop a watch list, be proactive. So a watch list for you, depending on where you're at around the world and what's moving and what you're trading, that's what you can start to develop. So account size, and again, this is strictly my opinion. If you have less than $10,000 to $15,000 in your U.S. dollars in your account, I think that you're forced to be a day trader in Forex because you don't necessarily have the account size to trade for a long time for days and days and risk the right amount to make the right amount as a long-term trader. So if you're dealing with 2,000, 5,000, 8,000, 9,000, 10,000, something like that, you're probably going to be a day trader. But the question you have to ask yourself is, do you have the time to be a day trader? And so that's it. And so trust me, the markets aren't for everybody, and Forex may not be for everybody, but there are markets out there that I think are right for everybody. You just have to make sure that you understand it out there. So the Forex markets, like I said, are unbelievable. They're a great kind of segue in between options, which are somewhat leveraged, and futures, which are too leveraged for most people out there and require too much money to be put up and can be very, very volatile and very decimating to an account because with Forex, as you know, you get stopped out before your account goes negative or depending on the amount of leverage you're using. With futures, the markets can run and run against you. You can lose everything in your account. You can lose your house. You can lose more than you ever had as these firms come after you if you make a mistake. So if you're struggling right now, finding out who you are as a market trader, definitely don't jump into futures. I think Forex is the right place to be, but you've got to approach it the right way. So the 0 to 10 might be pushing it. Maybe 10 and above you could get to be a longer term trader, but between 0 and 10 roughly, I think that you need to be a day trader. That means you need to spend 4 to 5 hours a day trading. You can't really put on long-term positions with that account size. If you have over 15,000, then I think that you can be an intraday trader, certainly, and you can also be more of a position trader. You can trade for a longer term. And my kind of theory on this is a day trader, depending on volatility, again, it depends on volatility, should be risking roughly 5 to 20 pips as an intraday trader versus a position trader could be risking 100 pips, 200 pips, 300 pips, 400 pips, 500 pips. All depends on market volatility and their trading plan and their setup. There are two other types of trading strategies or time frames, and those are called swing and those are called intermediate. Swing and intermediate, definitely swing is more of like a weekly time frame and intermediate is more of a monthly time frame for equities. Those fit into equities much better and options much better than Forex. I think that Forex, you kind of have to be one or the other because you can't really be a longer term trader like a swing/intermediate trader risking 30 or 40 or 50 pips and closing down the platform and walking away, because 30 or 40 pips we know can happen in the blink of the eye. You're either trading short term, opening the position, managing the position and closing the position and then walking away, or you're a longer term trader where you're risking the right amount to sit through the average trading range and the various news that's coming out 24 hours a day to make a longer trade, whether it's a hedge or whether it's just a longer trade taking advantage of a trend, the euro down or whatever it may be. So if holding a position, the question is, if holding a position for a week, what do you class that as? In Forex markets, by all, that is absolutely a long-term trader. Like I said, I think you have a day trader who trades in and out in the same day. And then I think that you have a longer-term trader trading for days or weeks or whatever it may be. I don't think that there's much in the middle here because I just think that the markets move too much and they're too leveraged for you to turn off the computer and kind of be in the middle ground in there. Again, this is just my opinion. This is how I treat the markets. This is how I teach the markets. And so there can be some, movement within those guidelines, but I think that these are pretty good, guidelines to start out with. So again, these are these 4 types of traders and what I require from these traders. So again, ask yourself if you're doing this. If you think that you're a day trader and you're giving it a half hour, an hour here, then 3 or 4 hours later, you're coming back for another half hour, an hour, I think that you're going to be impatient. I think that you're going to have trouble succeeding and competing against people that are watching the markets for hours and hours and hours and waiting for a setup to come. And if it doesn't come, that's great. Tomorrow's a new day. So day trader, intraday, scalping, or that term that I talk about, swalping, I think you need to be there at least 4 hours per day consistently in a row. And again, ask yourself, maybe you're trying to do this at a time when the markets aren't as busy. Let's face it. At about 4 or 5 o'clock New York time, when the markets close, Europe is sleeping. Now it's 4 p.m. in New York. The American markets are closed. And now the Asian markets are basically into their new day. And so look at the volatility. Go ahead and look in the volatility, at least in the pairs that I trade, if you're looking at the U.S. with some of these majors like the pound and the euro and the Aussie and the New Zealand, that's a kind of a slow time to be trading. So you have to adjust to be where are you trading at what time and what markets, are moving, what Forex pairs are moving at that time. So day traders, more than 4 hours a day consistently in a row. Swing traders, like I said, I'm not a big fan of this in Forex, but 2 to 3 hours per day. So I have a lot of equity and option traders that are swing trading for 2 to 3, 4 days at a time, maybe a weekly time frame, and they're there 2 to 3 hours per day. Intermediate, I'm not a big fan of this in Forex either, but that I require 1 hour per day on the equity and option side. Most people that I work with, most of them that I work with, they have a job. That's their income, and they're learning to trade. Like I said, in this economy where people are getting cut back in salary, maybe they're having other benefits and things like that cut back, so they're paying out more to keep that job, or they were laid off, or whatever it was. We know that the economy is different right now with jobs, so people are looking to learn to trade to add value to their own skill set, to add value to their income set, and things like that. So I have most of my traders that are learning equities and options, and maybe Forex is a longer-term hedging strategy, as a longer-term Forex trader. They fall into the intermediate time frame. They can't put in more than an hour or two a day because they have another life. They have a job. They have family. They have other commitments and things like that and other hobbies, and they're just trying to pick this up. And I do believe that if you're true to yourself and say, this is what I want to do with the market, this is how I want to use it, this is how I want to learn it, that an intermediate putting in 1 to 2 hours a day, you can be very, very successful in the markets. Maybe not so much in Forex, but there are other markets out there. So again, I shoot straight, and if someone comes to me and says, this is what I want to do, I'm going to tell them my unbiased opinion of what I think that they can handle. And then, of course, you have your position trader, whether that's in equities, options, Forex, whatever market it is. And again, market volatility assists with this process. Market volatility guides us how long the trade is going to take, how many contracts we should be trading, how we should be managing it, which type of orders and things like that. Market volatility dictates what we do. So someone was just asking, I think, Mike, okay, I think I missed a question here. I'm just going to read it for a moment. So someone's asking, do you find out that 2 of your 6 pairs, the Swiss against the United States dollar and the Canadian against the United States dollar, having almost opposite correlations to the 4 pairs and therefore opening opposite positions? They're actually the same. You have to remember there's 4 pairs that are against the US dollar. It goes pound/USD, euro/USD, Aussie/USD, New Zealand/USD. So the USD is the second of those 2 pairs. So if the USD is going down, the chart is going to be going up. With the Canadian and the Swiss franc, the USD/Canadian, USD/CHF. So it's the USD that's first. So if the USD is going down, the chart is going to be going down. So they're the exact same charts. It's just the Forex gods, for whatever reason, decided to make these different pairs, the way they wanted to, so that the USD is now the first pair against the Canadian. So the chart's going down, the USD is getting weaker. It's the same thing that if it was CAD USD, it'd be opposite then. So just remember that, that's the look. So they're the same entries to me. I think for the most part, there's some big intermarket relationships. And so, Mike, you're just a little bit ahead of me. That I'm going to tell you some other relationships that are out there between equity markets and things like that as we go into that in the next part of the presentation. So I think that they're kind of correlating together. You just kind of have to remember that some of these pairs are different and get used to looking at them the opposite way, as you said, but really they're trading the same way. So today I'm just glancing up at the markets, and for the most part, early today, the U.S. dollar was weak, but it looks like the U.S. dollar is starting to strengthen against all of those 6 pairs. And again, I think that has a little bit to do with equity markets and things like that we'll talk about. So Forex account types, again, this can be very, very, very confusing to people, and I don't want it to be confusing. Again, it's you. You fit in. You're a puzzle piece. You fit in a certain place. And so that's nice that the Forex markets give us these different options to have. So we have micros, we have minis, and we have standards. Most people out there should be starting with minis because that's probably where their account size is. If you have an account size of 10,000 and under, you should probably be using minis, because we're going to talk about account and trade risk. And this account and trade risk, the slide that we're going to go to next, it's very important. I think, again, people skip this step, okay? So micros basically are a penny each time one pip moves. So a pip up or down would be a penny. The mini would be the $1 per pip. So if you put on one contract, for the most part, depends on exchange rates, but for the most part, against the USD, anything paired with USD, for the most part, you can probably see one pip being equal to $1 if you had one contract on. And then you have standards, which are just $10 per pip. Again, this fluctuates a little bit. Some can be $7, some can be $14, depends on the different exchange rates, and you can see that pretty easily from your broker or on various sites. So where do you fit in? I truthfully don't believe that anybody should be trading micros, because micros, if you're trading that, you probably have $100, $200, $300, or $400 in your account, and that's fine. But really, if you're going to commit to doing this, you're going to need to put in a sizable account, and you need to have some real money, because if you're just trading for pennies at a time, it's not really real money to people, and people go, oh, I'm not trading for real, even though I'm going to treat this like a real account. I can just put this trade on here. I can just put this trade on here. And you become what I call the ultimate paper trader, and you're a paper trader for your entire life because you never take it seriously. So I think that having real money in the game, once you're comfortable with trade execution, is very, very important. So just as I'm looking here, I'm just kind of seeing questions come through. Do you trade Forex spot or futures? I actually trade both. They actually are the same charts to me, and they line up very well. So it just depends on what I'm trying to do, whether it's a day trade, hedge, and things like that. For different types of trading strategies, I use the different markets, the cash and the futures markets. Trading micro lots is just like trading on a demo account. So Mike, you're echoing what I'm saying. I believe that truthfully. I work with people and I get them live very quickly because I graduate them, quickly. They are not a live trader when I meet them, and then after a few sessions, I get them live because they have trading plans, because they understand themselves. The stuff we're talking about today in this webinar about the trading personality, I do that for people before I even sign them up. I say, if you're interested in working with me, I'm going to do this interview. It's my chance to know exactly where I'm taking this person, and if they're not on board, that's fine, but I'm not going to take the risk of them not having them be on board as far as what I think is right with my experience in the market, with reading the charts, with understanding fundamental news, and understanding individuals and what's realistic. So I set the tone right before, even before we go into our lessons together, and I give them this kind of what I call an engagement interview, and they can do whatever they want with it. They can say, Brian's crazy, I'm doing what I'm going to do, and that's fine, and best of luck. Or they can say, hey, this sounds good, let's go, Brian, I'm going to kind of listen and kind of be within your mold. So I think getting live very quickly, once you understand physically how to execute an order on your broker's platform, I think is very, very, very important. So where do you fit in? What account is right for you? Again, I think that minis are very, very good, because remember, we're thinking about the velocity of money. We're talking about what percentage your money can make, not dollars, but what percentage. If you have a $2,000 account and you made 1%, today, as an intraday trader, you made $20, that's fine, but where else can you make 1% on your money in a day? In the United States, our 10-year notes are giving 1.5%. That's 1.5% in 10 years, all right? In Australia, where their economy is doing a little bit better and they didn't have to lower interest rates like we did in America, you might be able to get 4 or 5% or 6% in a year in their bond market and things like that. But can you make that in real estate? Can you make that in private venture? Can you make 1% per day in your own business? That's why I say the financial markets are absolutely amazing if you approach them right and if you're realistic about what your money is doing. Do you open multiple trades simultaneously or one trade per time? It all depends. Lately, I think the markets have been a little bit less volatile, and I think that it's been kind of telling me to open up one at a time here. because the same setups that I'm looking for aren't kind of correlating the pairs. But if the setups that I'm looking for do correlate and there's multiple pairs, yes, I will set it up and I will open multiple trades. I'm comfortable enough managing 2 or 3 positions at once. But keep in mind that, that's it is the management. Is you have to be able to manage those positions. And then also keep in mind, you may have to decide on one pair might look a little bit better than the other. You might trade that a little bigger than the other. And instead of just trading one, now I'm trading 2 or maybe 3. And so I've got to maybe dial it back for each of those so that I'm still risking, even if I had a loser on all 3 of those for whatever reason, that I didn't blow out my account, management as far as how much I'm supposed to trade. So I still have to do some money management in there if I open up one and then open up another, and I just have to manage it. Again, that comes with time, with getting comfortable with the platform and things like that, and making sure that you understand how to go and manage those trades, change those order types, modify them, move your stops, take some off, things like that. So that's a good question. So account risk and trade risk. Sorry about that. I was just taking a drink of water. Account risk and trade risk, this is worth spending some time on. Let's see. Someone was just saying 1% a day doubles the account balance every 3 months. Yep. And I'm not saying that you can get 1% every day, but I said if you did 1%, if that was your goal, that's a very, very good goal to be very happy with, especially, as I said, in these markets, depending on volatility and things like that. But these markets have been screaming at me, and I write about this in my commentary, screaming to take profits, because the average trading ranges have been much, much, much smaller than what they could be if volatility was higher. So, again, my opinion, if you do have a winner, you manage it, and I think that there's nothing wrong with ringing the cash register and taking profit in these markets. We'll get into that as we go into volatility. So just keep in mind, where else can you get these kind of returns on your money? And again, in foreign currency markets, you don't have to put up a lot of money. $2,000, $5,000, $8,000 is doable. With stocks, you have to put up hundreds of thousands of dollars. Options, it can be about the same amount, $2,000, $5,000, $10,000, but you just have a little bit more leverage in the foreign currency markets. So account risk and trade risk, AR for account risk. It is an industry norm not to risk more than 2% of your account. How many of you guys out there listening have lost more than 2% of your account on any one trade? It's pretty common, all right? But that's the point, is if you want to be successful, you've got to cut your losses. You cannot let large losses damage your mental state, and you can't damage the state of your account as far as the size of it. So 2% for the most part. The larger the account, you might go to 1.5%. You might go to 1%. You might go to 0.5%. If you're dealing with millions of dollars, you probably don't want to be risking 2% of $1 million. You might want to do 0.25%. Who knows, 1/8%. So the larger the account is, you can always dial that back. So around 2%. If you start going 3, 4, 5, 6%, you have 5, 6, 7 losers, and you have half of your account. So you don't want to do that, especially starting out when you're trying to get, a little bit of experience. You may not be super comfortable with the platform, and you might make a mistake. I bought instead of sold, or I put the wrong order in, or whatever it was. I didn't mean to put in a market order. I wanted to put in a limit order. So keep your trading size small. Trade risk, TR. It depends on what type of trader you are and the market volatility. I mentioned this before when we were talking about the different types of traders. A day trader might only be risking 7 to 15 pips. Who knows? 20 pips, 25 pips. Again, volatility decides this. A position trader who's trading for days at a time, a week at a time, taking advantage of a trend, or as I said, maybe hedging some other portfolio or position that they have on. And that's the fun thing. Some people say, hey, gold is the next wave. I've got to invest in gold. And a lot of people invest in gold. Well, there's relationships between the gold market and currency markets with commodity currencies like the Australian dollar. There's relationships between the oil markets, that a lot of oil and energy come out of Canada, and then you have the Canadian dollar there to maybe hedge that. So you could be hedging an equity portfolio, you could be hedging an underlying commodity that you hold. You could be hedging maybe with these relationships. Someone mentioned, hey, I see that some of these pairs are moving together, the pound and the euro are moving together. I have a long-term position in the pound. I could use the euro maybe to hedge that, and go the other way at times. So lots of different fun relationships out there. So a position trader should be risking more than a day trader. 75 pips, maybe 100 pips, 200 pips, 300 pips, could be 400 pips. It depends on the market volatility. The bottom line, though, is even if I'm a day trader and a position trader, I don't change my 2%. I don't change my 2%. Do you believe this theory that 95% of new FX traders lose all their initial money in 3 months? That's what someone was asking. Do I believe the theory that 95% of new FX traders lose all of their initial money in 3 months? I'm not sure. I don't check into these different stats or anything like that. I'm sure that there's someone that might be keeping track of that. I'm not sure if brokers give that information out. I do believe that lots and lots and lots of traders do tend to blow up an account rather quickly or lose most of it and kind of get stunned. But I promise you, if people went through this honest look at themselves, I think that number would come down. I just don't understand why people look at the markets, whether it's Forex, whether it's futures, whether it's options or stocks, and they say, this is my lottery ticket. This is my holy grail. This is a business, you guys. I treat it very seriously. I treat my clients very seriously as far as their work and their time that they're putting into this and their money that they're going to put into this. And I think that they're going to learn a great skill. But it is a business, all right? Most of you out there have worked for a company, might have been business owners in the past, might have been successful enough to retire early. This is no different. Approach it as a business. Do not approach it unrealistically, all right? You have to know what you can afford to do as a trader, meaning your personality and what's right for you. And then you need to know how to read the charts. So we're not even going into technical analysis. We're not even going into fundamental analysis yet. That is the hard part, you guys. I can't stress this enough. This stuff is easy. This is the easy part. Who am I? How should I approach the markets? When should I be trading? How many pips should I be risking? How much money should I be risking? This is the easy part, you guys. Everybody can do this if they took the time. The hard part is sitting in front of the markets, being patient, executing an order, managing it correctly, taking off the profits when you should be, getting out of a loser when you should be. That is hard. And I've been doing this for 15 years, and that's why I love talking to you guys, and this is why I love teaching. It makes me a better trader. I learn more from doing this and teaching, okay? There is no doubt about it. But just do this step. Go through this part. Review this webinar if you can. Take good notes and go through this and really sit back and say, what can I achieve, all right? I think that 95% number, if that's really the truthful number out there, I think that it can come down there. Market volatility, all right? So this is huge. I'm guessing that a lot of Forex traders haven't heard of the VIX before and haven't paid attention to it, but you guys have to be paying attention to this. The VIX guides us. That's what I said in the outline. The VIX guides what we do. So are you using this guide to help you with your trade frequency and your trading size and manage your trades? If the volatility, if the VIX is low, all markets have smaller ranges. Okay? That's pretty true. All markets have smaller ranges if the VIX is low. Right now, what's going on in our economy, okay, is it's a weak economy. It's weak in Europe, it's weak in Asia, it's weak in the United States, or it's getting weaker in the United States. And the equity markets are flying. The equity markets go up every single day. Unemployment has not changed in America in the last 4 years, roughly 8%. The equity markets have doubled in value, over 100% in the last 3 years. Just to give you some percentages and some time frames here, over the past 30 years, the equity markets in the United States have averaged 10% per year. 10% per year average over the past 30 years. In the past 3 years, they've done over 100%. And the economy around the world has probably gotten worse. Europe is worse than it was 3 or 4 years ago. The United States economy, I'm not really sure, but I don't think it's great. Unemployment is still high and it could get higher. So there are rumors out there. And what are those rumors? The rumors are the worse things get in the world, in the economy, the more likely it is central banks around the world and International Monetary Fund, the IMF, will help us out. And that's what's going on right now. And those rumors and that need and that thirst for help from central banks, from governments intervening in the markets, is keeping volatility low. But these rumors come and go, So sometimes volatility can get really, really, busy, and markets can move, and as we know, the Forex markets can just run, all of a sudden, and we don't know why, and it's a rumor. So you have to keep in mind in this, as I call it, rumorville, okay? Rumorville, the volatility is a little bit higher than it actually is. So you just have to be aware of that as a trader, that anything can happen anytime in any market, but in these markets more so. It's not fun when you're a trader that does a lot of fundamental analysis and technical analysis, and all of that can go awry, okay, if for some reason Ben Bernanke or Draghi over at the ECB come out and they have, they say something. So you guys have to be aware of this, that even the best of the best, and I'm not saying I'm the best trader out there, there's always someone better, bigger and better, right? Faster, whatever it may be. But all the best laid plans can go awry at any time, and that's why that account risk of 2% is so important. If you start to get, big eyes and you start seeing something, just remember it can change in a heartbeat. And the markets, as we say, as all my friends that I learned to trade with, we get slapped on the wrist. And the goal is to just get slapped on the wrist less and less frequently and in smaller amounts. So be careful. Don't get those big eyes, that big stomach. I'm gonna go for this trade. Don't do it in these markets. Don't do it in any market. So the volatility is really driving what we're doing. I do believe that. So what we're going to do is we're going to go into some intermarket relationships and start to help you. But first, we're going to go into and spend some time on the equity side and showing you this VIX and showing you the S&P 500, which is the major index in America, just so you can see what the equity markets are doing, what volatility is doing, and then we're going to start to move, and I'll show you that relationship, what the VIX means for the majors, okay? So I'm just going to pause here, actually, and just give you guys a break. We've been going pretty quick here. Just give you guys a break. I'm going to get some water, and I actually have to open up this one application. So I'm just going to be gone for about 30 seconds while I open this application, and I'll come back to you, and you'll be seeing the equity market. So where we're going is volatility and the equity markets, and then volatility and the majors that I focus on. So while I'm bringing this up, someone is saying FX is highly manipulated. Watch the GBP USD. Again, I get upset, I think, when people have these, conspiracy theories. I believe that, yes, like I said, anything can happen anytime, but I don't believe it's necessarily manipulation. If you want manipulation, then the governments are manipulating this. The governments are stepping into this industry to traders and saying, no matter how bad the economy is out there, we're going to keep the equity markets up. So we should be a lot more volatile, guys, than we are right now, but governments are manipulating this. So that's where it's manipulated, is if no matter what you guys do, if it was sales or marketing, no matter if you're in the health profession or IT or whatever it is, if the governments came in and said, we're changing things, you guys would stop what you were doing in that industry and listen. And that's what the government is doing right now. In America, at least, it's called Dodd-Frank. It's an act as far as where people manage money and the different regulations they have to basically be within those guidelines. They're changing every single day because, again, I'm in that money management realm, and it's just amazing what's coming out of Washington, D.C. here. And then obviously, like I said, around the world, these central banks are getting together and they're saying, we're going to keep the markets up. So they're taking volatility out of the markets, and that's what traders have to know. One of you guys might be a brand new trader. Oh my God, the Forex markets, they're going to be great. They're going to solve all my problems. And these are very, very, very tough markets to be trading in right now. So I wake up every day. I don't expect to trade every day. If I expected to trade every day, I'd be done as a trader. Years ago, when we were more volatile, yeah, I was pretty confident I was going to be trading once, twice, 3 times a day, probably, maybe 4 or 5 times a day. But times have changed, and that's what I want to show you guys. This volatility tool right here is going to help you a lot. So let me just make sure that my charts are up, and I'm going to show them to you in just a moment. So remember, no conspiracy theories out there. The markets can be solved if you approach them realistically. So I'm just going to bring up the VIX, and I'm going to go ahead and share this application again. Okay, let me bring this up. And again, as I mentioned, I'm going to show various brokers and things like that. Please, there aren't any recommendations for brokers or trading strategies, anything like that. No buy, hold, or sell recommendations. This is just something that I'm comfortable with, and there's no way that even if I work with people all over the world with different brokers and things like that, I can't learn every one. That's kind of the homework assignment I give them, is learn your broker in and out. Charts are all the same no matter what broker you're on, and most of the tools and things like that, but you need to know how to actually buy and sell and that kind of stuff. So someone just was asking, I guess, I'm on my laptop here and I have my 4 trading screens in my office up next to me. Someone is just asking about the Euro Swissy. I could bring it up, but me personally, I don't trade it, so it's not something I watch. Again, I have a finite watch list, so I'm not sure what's going on with it. I'm just watching the U.S. And just to give you guys some background, if you guys have been watching the stock market today, I'm going to show you guys this. The stock market was going up all morning. Now it's negative. The United States dollar, as I said, was going down all morning. Now it's going up. There is a relationship out there between equity markets and Forex markets. And as a hedger and a long-term trader, and as a short-term trader, that's a fun relationship to use if it's working. So this is VIX, the Volatility Index, Victor India X-ray, VIX. Okay, and I'm going to show it to you on a yearly chart. Okay, the VIX is low. Think of the VIX as an opportunity gauge. The higher the VIX is, the more volatile markets are. The more fear and uncertainty there is, and traders love fear and uncertainty. And someone's just asking about the Australia-US dollar. It's starting to get weaker, the Australian dollar, because again, most of the New Zealand dollar is the same thing. New Zealand against the US dollar, it's starting to weaken a bit too. So the US dollar is strengthening a little bit as the equity markets come down. Equity markets have done very well. I'll show you that over the past couple of weeks. So the bottom line is this volatility right here on the left side of the chart, that was last summer when there were riots in Europe and there were fires in the streets of Greece, and VIX was in the 40s. Now, Europe seems to be worse off, unemployment higher, economies are collapsing, and the VIX is at 15. Why? Because governments intervened and said, we're going to help the markets out. How do we know that the markets are helped out? Well, I'm going to show you right now. So take a mental image of the VIX being high last summer, then low. It peaked up a little bit this summer at the beginning, and now late June, July, and August, it's gone back down to its lows. What has the S&P done, the broad index for the U.S. markets? What has it done at the same exact time frame? Okay? Last summer, when the VIX was high, when Europe was on fire, in a bad way, S&P was low. Then the VIX went down and the S&P went up, 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 up. As I said, the VIX picked up a little bit early this summer and the markets went down. And then as of late, the markets have gone up, 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 up. No matter what's going on around the world, slowing demand in China. Europe is going, berserk over there, starting to see worse economic data coming out of the United States, and the equity markets are going up. That's manipulation. That, I believe, is manipulation. But the fact is, if they're being manipulated or whatever the reason is, I understand it, I see it, now I develop trading strategies around it. We focus on percentages, you guys. The United States market since June, as economic data has gotten worse around the world, has gone from 1265 to 1375. That is 110 points in a month and a half. As economic data around the world gets worse, 110 points, that is 8%. I said we do 10% per year on average. We just did 8% in a month as the markets get worse. We are very close to our old highs here. 1420 in the S&P was the highest point we got to. We are at 1370 something. We are very, very high in the face of bad news. So volatility is low because central banks around the world are booing equity markets. As equity markets go up, fear goes down. The VIX is a fear gauge. Uncertainty goes down. Anxiety goes down. Trading ranges go down. This is not the best market to be a day trader in. I can tell you that right now.
it is a good market to be a day trader, and if you're realistic about how often opportunities are going to come, and it may not be every single day. So someone was asking about the Euro Swissy is flat without any sign of life thanks to the effective peg of the Swiss National Bank. So again, yes, so someone who's following the Euro Swissy, you're paying attention to fundamentals, and now you're developing trading plans for that specific pair in this specific economy right now. That could change tomorrow, but as far as it being in that range or whatever you're looking at, please then trade it realistically. Someone is saying short is absolute manipulation. Also, VIX is near basing levels around 15. So next move in VIX likely to be higher in topping equities. So that's a good point. So someone is looking at support and resistance, and I kind of tend to agree with this person. Again, this is for educational purposes only. But what they're saying is they're using, look at the longer term. This is months and months and months. This is not a day trader. This is someone looking at the longer term, and they're looking at the support that was down here, and I'll show you the price of it. And let me get this up and running, my cursor. So this support was all around 13. Volatility just went from 27 down to about 15, and it's getting close to that support level. So remember, percentage-wise, it went from 27 to 15. It almost dropped by 50%. But it's just not moving anywhere. It's going sideways. As long as the markets go up and sideways, volatility is down. If you wanted to protect your equity portfolio, and you know this relationship, if equity markets go down, the VIX could go up. You could go long the VIX or buy long-term options on it, and hopefully someday the markets go down and your trade would make money as the VIX went up. That is that relationship, okay? So just want you guys to understand that volatility is low, way lower than last summer, and we know things around the world, economy-wise, are slowing and worse than last summer, but not according to the VIX and not according to the equity market. That drives us. Trading ranges are small. So I'm going to stop this application, and I'm going to jump into our Forex markets, because that's why we're all here. This is FX Street after all, right? And I'm going to see if I can keep this. Let's see what happens if I do that. Okay. So I'm going to bring up the pound US dollar, and let's see how much time I can bring up here. Okay. So now we're looking at Interbank FX, IBFX, in their MetaTrader platform. Most of you are probably pretty familiar with MetaTrader Floor. Again, this is not a recommendation for Interbank FX. It's just some of the work that I do out there, and one of the places that I do have an account with them. And again, no matter where you have an account, most people have the MetaTrader 4 platform, so you're probably pretty used to looking at that. But the bottom line is volatility and trading ranges in the markets here in Forex are smaller than what they were last summer, and that's what we just have to understand. Trading ranges used to be on average 150 pips a day. We are not seeing 150 pips movement a day. So trading opportunities, the up and down swings each day are just smaller and less frequent, and that's how I have to go ahead and base my trading decisions off of and be realistic about how much profit I get. So volatility drives me. No matter what trading strategy I'm doing, no matter what market I'm in, volatility drives me and keeps me realistic. I can't stress that enough, okay? So we're going to go into a little bit more of this down the road as we get into the next presentation, part 2. So let me just go back into the PowerPoint. I think we've hammered on volatility enough. I think you guys are pretty aware of how I use that. Focus on the percentages. Again, your account size and velocity of money. How much of your account are you actually using? That's the great thing about Forex. You could have a $2,000 account and probably be, as I said, a day trader, and you risk 2%. So you're only pulling out of that $2,000, you're only pulling out $40. 2% of $2,000 is $40. This person's probably going to be a day trader, so they're only risking 7 to 15 pips, something like that, depending on market volatility. So if this person was a very, very short-term, almost a scalper, and they're risking 7 pips, just divide 7 pips into $40, and that gives you 5 contracts. You can't do more than 5 contracts. with the US dollar pairs being about $1 for us for a mini lot, and every pip up or down is $1, just divide the amount of pips you're risking into your account risk. So your trade risk, TR, is the amount of pips you're risking. Your account risk is the dollars that you're able to risk of your account, your 2%. So the 2% is your constant. The TR, the trade risk, the 7 pips is the variable. If you wanted to risk 15 pips, because that's what your trading strategy told you, then you just divide 15 pips into 40 and you're only doing 2 or 3 contracts. The bottom line is I'm risking $40 no matter what. A little bit here with commissions depending on the broker and things like that, if they put the spread in. And if I have a 1 to 1.5 risk to reward, I'll make 60. If I risk 1 to make 2, risk 40 to make 80, I'll make $80. So $60 on a 2K account is 3%, and that can be done in minutes. As we know that, no doubt about it, the Forex markets can move 15, 20 pips in a 5-minute bar, 10-minute bar, 15-minute bar. So within minutes, you're either risking 2% to make 3, 4%, something like that. If you did that, that's a very good day. Knowing volatility, thank you very much. I'm done for the day. I'm closing shop. Or maybe you say, I'm up money for the day. The next trade I make, I'm only going to do 1 or 2 contracts. And even if I have a loser, I still end up money for the day. So it's always about your gut inside telling you, hey, what's going on today? Is it busy? I'll put on another, but maybe I'll cut my size. It's not busy. I just had a winner. I'm closing up shop, going hiking, doing whatever you want to do. Go into your consulting mode or whatever you do for a living, go to your family, that kind of stuff. You don't have to spend 10 or 15 hours a day in front of these markets. A day trader, 5 to 6 hours. A longer term trader, a little bit less. But I don't want to hear people in front of the markets 15 or 20 hours because you're working way too hard to make a small return on it unless you're doing really well with a big account. But if you have a $2,000, $4,000, $5,000 account, you're trying to bang out $20 a day, $50 a day, $100 a day. I don't think you should be working 15 hours for $100 a day. That's a lot of time to make a small amount of money. That's not a good return on your investment. Be realistic. Day traders, what is realistic given proper trade risk and what the markets are giving you? I just talked about that. Trading ranges are smaller, okay? So 5 to 10 to 15 pips, if I get that, I may not get another opportunity, and that's just fine. But I can't be looking for 50 pips or 100 pips or 200 pips when the trading range is only 100 pips a day. The U.S. Canadian is notorious for being in a pretty tight range as of late, and just moving around in like a 200 to 300 pip range. And that's been going on for months and months and months and months. So let the markets tell you when to trade, how often to trade, and how to manage the trade. Let the markets tell you. Brian, do you really stop scalping when you reach your daily target, or do you keep on scalping for hours of a day if it looks to be very volatile? I'm in front of the markets all day, so the person's asking me, do I have the discipline to stop trading after it? I'm notorious on Fridays for if I have a winner, I'm out of there just because I like to end the weekend on a good note. And if I have a loser, then same thing. I may not choose to trade again just because I don't want to do something stupid and have 48 hours to think about it. So I'm very much into trading psychology. No matter if I'm talking to someone in a one-on-one session, I'm teaching a class, I'm doing a webinar for FX Street. I am very, very in tune to trading psychology. So these days, I don't think there's anything wrong with having a winner and being fine closing up shop. It's just been for months, you can see the volatility. When the volatility changes, I'll change my approach maybe. But yes, I don't mind closing up shop. And usually I've had better results when I close up shop because, again, just volatility seems to die as the day goes on here in the United States especially. So same rules apply for a position trader no matter what. Be realistic. Let the markets tell you how to trade it. So the bottom line, you guys, is if a ski bum can do it, anybody can do it. But it does take time, it does take discipline, it does take focus, it does take hard work, and it takes giving yourself experience. Don't blow up that account before experience. It's not worth it. Trade the right amount, trade small, use, the different websites and things out there, and use me. I write commentary every day for FX Street. I do webinars and things like that. So please take advantage of the good education out there. Allow yourself to gain experience by trading correctly, given your trading personality. You guys now have a little bit better understanding of your trading personality. When the VIX is low, that is not when the market is trending. So the markets can trend. I mean, the Australian dollar has been trending up from 95 to 103. So the VIX has nothing to do with trending. The VIX has to do with amount of movement each day, trading ranges, and up and down swings and up and down and up and down. When the VIX is low, you might get one good move, and then it could go very sideways. So the VIX just means the amount of movement, the amount of flow is less when the VIX is low. It has nothing to do with trending or range-bound markets. Review. You learned about me and my trading strategies and what Jupiter Peak Financial does. You learned about your trading personality and how to hone in on it. You learned that volatility drives us no matter what market we're trading. Forex traders should be paying attention to the VIX. You learned to be realistic. The VIX tells us, the markets, the average trading ranges, your technical analysis tells you what is realistic for your trading strategy. Your chance. As I said, you're the system. I provide this to people on a one-on-one basis via Skype or via phone. It's your chance to get grounded. I go over account risk and trade frequency. In my unbiased opinion, I shoot straight, my unbiased opinion, after asking you these direct questions, what I think is achievable for you. It is free. There is no obligation. You will then get a summary of what I've learned from you, and you'll have all of my education that I provide out there, the webinars and the blogs and things like that. It's unbiased, so some people may not like what I want to hear, but I don't owe you anything, and it's just my chance to say, this is what I truly believe. I do shoot straight. So that is just something that is open up to everybody who's listening in today. You can get a hold of me via email if you'd like, or through the FX Street website. Resources, my FX Street profile, I'll go there in just a second. I already did. But my daily market commentary, I'm not expecting you to write this down. But again, you can go to FX Street and search for Brian Kahn, and you'll find that. I also do recordings. I've done about 20 or so webinars for various brokers, including IBFX. You can find that on YouTube under what I call mine, the locals take. The locals, when you're trading for your own account in the pits, you're a local. And so I just do everything off of the locals take. So if you go to YouTube and go for the locals take, you'll be able to find that. You can also go to, because I do them for IBFX, you can also go to IBFX's channel. Those one-on-one engagement interviews, there's my email, your chance to get grounded. So let me just kind of read some questions as we have a minute left. When is the exact time we should buy the options on the VIX? No buy, hold, or sell recommendations. I don't know you. I don't know what you're trying to achieve. Is it a day trade? Is it a long-term trade? You've got to make a trading plan based on your fundamental and technical analysis and what you're trying to achieve out of the VIX. So your conclusion is that the magic formula is myself and the way I trade. Your conclusion, the magic formula is yes. You are the system. Once you understand that and are true to it, then you can go on and start to learn the fundamental and technical analysis that apply to you. You first, then all the other stuff. Okay, and then someone said if the VIX is low, does that mean the price is not as chaotic? It could be, yes. So it just means it's not as chaotic, but that doesn't mean that it's not trending. Like I said, there's been trends going on. The Australian dollar has been trending wildly up against the US dollar for the past few weeks. It's gone up 8 pennies, 800 pips, I think. And so I was just saying, yes, I work on my laptop just because I'm developing education, things like that, and I have all my webinars and things like that over there, but my 4 trading screens are specifically for trading. So I have 4 trading screens that I'm looking at right now that I'm glancing over to see all of the pairs and things like that. So I sit at home. I don't like trading from a laptop. I trade at home where I'm comfortable, or my home office, I should say, where I'm comfortable. So someone said, but different pairs have different volatilities, correct? Yeah, different pairs have different volatilities. Again, just depends on the range of those, but overall, those ranges are less than when they would be if the VIX was higher. Going back to the question about multiple monitors and trading on a laptop, I don't like working on a laptop. If I'm on a laptop, it means I'm not where I should be. So on vacation, vacation is vacation. If you're, at work or on your phone, I think it can be very hard to get all the information you need. You need to be dialed in and focused, you guys. Really, really focused. And I have a hard time you can be doing that on a train, on a bus, or whatever it may be. I just don't think that you're trading with the right amount of information. So trade where you're comfortable, trade where you're focused, trade where you think it's a business and a profession. Treat it like that. If you have any questions, you can get a hold of me via email. Just really quickly, I want to jump into FX Street as we wrap up this first session. and we do have another session coming at you for another hour and a half where we'll go deeper into technical analysis and fundamental analysis for specific trading types. So let me just bring this up. So the economic calendar, great resources here that FX Street provides. And so you have your, under fundamental on FX Street, you have your economic calendar. I use this each and every day to see what's going on, and great information on here. So economic calendar, I'll talk more about that in the next session. Fundamental reports, great analysis here under fundamental reports and news and things like that. And again, under the news, right there, GBP broke out above resistance. GBP USD jumps above 57 even. It's come back down a little bit since then, but it's breaking above some resistance. I think a trend line up there. And again, my author page right here, just search for my name in there, and almost every day there is an article written. I may not get to it today, pretty busy today, obviously. Keep an eye on the markets and doing the webinar today, but there are 3 reports, Monday, Tuesday, and Wednesday. There are already reports. The most recent one, trading opportunities using intermarket relationships. So sounds like some of you may be joining me for the next session. I'm going to take a break. I'm going to get some water. I'm going to see what the markets are doing and get prepared for the next session. So thank you very much. I hope you learned something today. Take advantage of the ongoing education I provide and FX Street provides. So remember, it's all about you.